Good afternoon. Pleased to be here. Thank you, John, for inviting us. And this is an ongoing project that is part of a large project funded by the Sloan Foundation looking at work-life transitions in the public sector. And as part of this project, we spent a lot of time working with the North Carolina retirement systems, both for state and local, and or state workers, and then city and local workers. And they've given us access to a lot of administrative records, and then we have conducted 3 surveys of retirees and workers as part of this project. And this is one area that we found interesting as we were moving forward. And in fact, I guess we could give credit to the state retirement system for actually asking us about this, because this is as you will see as we go through and explain what this Social Security leveling is, an issue that has caused them some concern, because when the leveling occurs, people complain. And so let's find out what Social Security leveling is all about. We could do a little poll and see who's heard of Social Security leveling before. I've been asking a lot of people this, and most people say they've never heard of it. But of course, my co-author, who knows everything, said, discussant who knows all about these things, said he had heard of it. But as part of this study, we called directors at the BLS, and we called people at the Department of Labor, and asked, because we were interested in what's happening in the public sector relative to the private sector. They all said they had never heard of it, and they didn't collect any data on it, and they didn't collect data on annuity options of public pension plans or private pension plans. They do know whether the company offers lump sum distributions versus an annuity option. So just the key questions that will come out of this project, and I'll let you read those. But the first and foremost thing is, what is something called Social Security leveling? So to start with, we think about, well, what do public pensions offer their retirees? They offer a lump sum distribution across the board. They offer people single life annuities, or they offer them joint and survivorship annuities. And oftentimes there are a variety of the J&S options, from 50% to 100% versus some pop-up things and things like that. People mentioned the annuity puzzle before, worrying about people not taking annuities. That's not an issue in the public sector. Part of it's the way lump sum distributions are calculated. These plans are not subject to ERISA, so they calculate lump sum distributions basically as the individual worker's contribution over their lifetime, with no employer contributions added to that. And then most states provide some interest accumulation on these, but basically it's saying you've worked all your life, you have this distribution that comes from that, but you get no credit for the employer contribution. Luckily, as part of this project, if we go back a couple of, you'll see that there are co-authors here, and Melinda Morrill is in the audience. Robert Hammond is also at NC State. But our final co-author, David Vanderwey, is an actuary, so he's kept us straight on that. And he also, for a while, was the chief policy person for the North Carolina State Pensions, now is in the state legislature's research office in charge of pensions there. So we're pretty sure we got all the details right and all of the actual calculations, and Melinda's worked very closely with David to make sure that we've done our calculations right, and he's gone over them. So I think we're in pretty good shape on that. So we're still trying to figure out what this Social Security leveling is. Because they're not ERISA plans, joint and survivorship annuities are not the first option or the default in public plans as they are in the private sector. So a Social Security leveling, the person chooses a single life annuity that front loads the payments. In other words, you're in a sense borrowing money forward from the system, so you get a higher benefit in your first years. But then when you reach a particular age, and in North Carolina's case that is 62, as we'll see going on, then your benefit comes down on the assumption that you are going to get a Social Security benefit there, and the sum of that benefit is equal to the earlier benefit, and we'll show some examples of that. But the only way you get this, if you want it, is that you have to choose a single life annuity to begin with. So keep that in mind as we go forward. So one could think about this as maybe a desire for consumption smoothing throughout your lifetime, because you're trying to maintain your total retirement income the constant before and after age 62. People with a really high personal discount rate might like to move money up, and we'll think about that a bit. And then also, we are worried a bit about trying to understand if there are any unintended consequences of this plan that allows people to move their money forward. And the two that strike us as most interesting that need some further work are the fact that if you have this higher benefit, you may be less likely to work after you leave your public sector job, and the fact that you're facing a decline in your pension benefit at 62 if you don't take Social Security at 62 is pushing people forward and claiming as soon as they can. So how does this work? A person has to determine what their Social Security benefit is expected to be at age 62, get an estimate from the Social Security system that says if you don't work anymore, here's the benefit that you'll get at age 62. The Social Security Administration provides that. Then the person takes that to the retirement system, and they give it there, and then the system, using a formula that we'll see in a minute, determines the benefit that you can receive from retirement age out to 62, and then the lower benefit that you would receive after age 62. Nobody's actually required to take the Social Security benefit at age 62. Be nice if we had some data on that. We are in the process of trying to link some of our surveys together so that we can actually observe what people do, but you've got to wait till they cross 62 to see whether they took the benefit at that time. And we don't have any direct link to the Social Security data there. But the system doesn't check whether they actually take it, but our prior would be that most people in the face of this lower pension income would in fact start Social Security. So basically, here's the formula. Most people, this B max is the benefit that you would get if you retired and you took the benefit formula directly out of the plan. So it's basically that M there is the multiplier, the generosity parameter that most people talk about. The slight difference between it, we really have two plans. One is for state employees and teachers. The M there is 1.82% per year of service. For city and county workers, it's 1.85, so a little bit, but by and large, these plans are basically the same, and we've put the people together in this analysis. They both have the same annuity options. The average final compensation is over 4 years. It's the high 4 years. There are early benefit reductions if you don't have 30 years of service when you retire, or you're not 62 with 20 years of service, or you're not 65 with 5 years of service. So sort of standard in the public sector. North Carolina's plan is sort of right in the middle of the generosity of public sector plans. We've got some papers that would show that if you're interested there. And so then what does Social Security leveling do? The system makes this calculation for you. That's the F, which is a factor, which is fairly complicated, that Melinda spent a lot of time working with David on to make sure that we understood the factors. But basically, it's taking into account mortality assumptions and some other things. And there's no survivor benefit, so we don't have to worry about the survivor's age or anything of that nature. So it goes through and they calculate, given your benefit max, or the benefit that's specified in the formula, what's your benefit before 62, and then the benefit after 62 is actually the benefit before 62 minus your Social Security, and that's hence the name leveling, is that you get a combined income from pension and Social Security that's the same for the rest of your life, abstracting away from COLAs or anything of that nature at this point. Okay, so this adjustment factor, just saying, based primarily on mortality, and an interest assumption, which the system provides is a 7.25% discount rate or an interest rate, and that is exactly the same thing that they assume that they're going to make on their money. But one way of thinking about this is they're saying, we're going to make this much money, and we're going to sell you this higher benefit early in life at that same rate. And you may not think they're going to make this money, but anyway, it's sort of a linkage there. And so we calculate the benefit that a person would get based on their years of service. So we've got lots of people, and we're going to calculate their exact benefits and work through this factor so that we can see what their maximum benefit would be and then what their leveling benefit would be. For an example, we take a person age 57 who is leaving the Social Security system, the North Carolina retirement system, and that's the mean of retirees in our sample. And we're assuming, just assigning them for the purpose of this example, a monthly benefit of $2,000 per month at age 57 based on their individual record. Again, slightly off from our sample mean. We are assuming that kind of person would have a Social Security benefit of $1,200 at age 62. That would apply a PIA of $1,600 at 66. And then we use the systems methodology exactly to calculate their benefit. So that's sort of answering question one. What is this thing that we're talking about? Question number two is this just a curiosity or do a lot of people use it? And so to answer this question in two ways, we look at a large number of large state-managed plans for teachers and local workers and state employees. And I can tell you who they are if you're interested in. Of that 85, 17 of them are not included in the Social Security system, so they're teachers and there's some states that are outside the Social Security system. So take those 17 away because you can't level if you don't get it. And so then we look at the remaining 68 plans, and 20 of those offer this Social Security leveling. Most of them, 15 out of the 20, offer leveling at age 62. Some people say 65, probably a holdover from when 65 was the full retirement age. One state exactly says it's going to be the full retirement age, so they will have this gradual there. And one state says, this is actually Virginia, that you can level between 62 and 60, and the full retirement age is 66 for now. So we ultimately would like to do some further analysis on these other states, but right now we're going to stick with North Carolina, which is one of the 15 that has that 62. So we're looking, as I said earlier, the North Carolina Teachers and State Employees System and the local government system. We have a data set that's been provided to us from the retirement system that includes everyone that retired between 2009 and 2014. I guess I should rephrase that. Everybody that started benefits during that 5-year period. It starts off being 72,000 people. If we look only at the people that could have chosen Social Security leveling, that's 37,000 people that started their benefits prior to age 62. Interestingly enough, for those of you that are interested in social policy and the federal government having this joint and survivors as the default option, 70% of the pre-62 retirees choose a single life annuity. That means only 30% are taking a joint life annuity. We can talk a little bit about what kinds of workers these are if you're interested in that. About 1/3 of those choosing a single life annuity chose leveling, or about 1/4 of all the retirees that were eligible for this were choosing that. And we have this nice chart showing the percentage of people choosing single life annuities over time, and you can see that it's been fairly stable with a little downward reduction, and part of that may have been due to some changes in the pricing of joint and survivorship options where a few more people were choosing joint survivorship relative to the single life annuity. And I've already mentioned these. These are when you can retire 30 years without any age requirement, so that's why we have a lot of these younger retirees, and ultimately many people are in fact retiring in their 50s. So who's choosing Social Security leveling? So this chart is showing the proportion of people in these various age categories for these years that are choosing Social Security leveling, given that they chose a single life benefit. So of the people that retired between 44 and 54, started their benefits, half of them are choosing this benefit option, this annuity option. And 1/3 of those people that retire 55 to 59, and once you get closer to 62, it's sort of a non-issue, is the amount would be only for a few months. So again, now what could be driving these people to do this? We talk in the paper about consumption smoothing. We've already mentioned that. High discount rates might want to pull your money forward to that. Certainly, if you had a good guess on your life expectancy and you were going to die pretty soon, you might want to choose this, and you might just make mistakes or have low levels of financial literacy, and we've got financial literacy queen here with us today. We're working on that. We have a number of different questions in our survey about financial literacy, the standard 3 questions that Anna Maria and Livia make us ask on every survey. So we've got that, and then we've got some survey questions about how self-reported financial literacy in there, that the questions have been used before. So we're in the process of trying to look at those more carefully. So one way of thinking about what we've done in this paper is to say, well, let's assume that a person has already decided on their age of retirement. So, obviously that's a big assumption, and people might link annuity options to when they retire, but I'm not so sure that would be a big issue. That they've decided to claim retirement benefits when they were retiring. And perhaps a bigger assumption here is they've decided to choose a single life annuity. So we're only going to be looking at those people that meet these criteria in some of the statistical analysis later on. This issue of 7.25% discount rate, while you might think that's high, if you look across public pension plans, that's actually pretty low for the public pension plans' assumptions about the assumed rate of return that they're going to earn on their money. A lot of states are, I would say, the range is usually 7.5 up to 8.5. So North Carolina generally is pretty conservative in the assumptions that they use. So to do some analysis, simulations of the level of benefits that people assume are going to get, we start by saying, well, let's go back and do our simple calculation here before. What would a person get before and after Social Security at 62 under a leveling example? And then what we want to do is to think about what does that mean in present value terms. So we know what it means in terms of monthly benefits. How does that play out in terms of calculating the present value, so you can think about, is this a good deal or a bad deal? And so we start off with this assumption that we're going to do exactly what the system requires. They make you an offer, and you get to accept or reject the offer of Social Security leveling. Then how you value that, of course, is somewhat different. The system itself uses a blend mortality rate ultimately, so they're making a gender-neutral offer. But of course, people typically recognize their gender, and they can make their own calculations if they know something about their life expectancy. And so here's our chart here. If you look at it, the maximum benefit that people would get, that's what the pension promise is. You're retiring now. If you want the flat annuity for the rest of your life, that's $2,000 each month for the rest of your life. If you wanted Social Security leveling, you get this blend, the B1 before 62 and then after 62. And then we have Social Security there kicking in, assuming that you're going to take that at age 62. So then if you go over to the present value calculations, if you use 7.25, which is what the system does use, then the question is, if you were to calculate your expected present value using that same assumption of 7.25, then of course you get the same present value for the two, and we get a slightly different number here because this chart is for men, and it shows that since men have less of a life expectancy than women, they are going to get a little bit higher present value because they're going to die sooner, and that you get the same number of high-paying years up to 62 and shorter years after that. If we do this for women, and it's also in the paper, you can see that women have a leveling effect that is going to be less than what we see here, than the average, because they're getting more of the low-paying years out there. And then we show that if you used 7.25 as your personal discount rate and you started Social Security at 62, we have our amount. It tells you what the present value is, and then you can compare it with the present value at 66. So if we think about those John and Sita's paper, I think this sort of fits in with that. What they say, if you have a high discount rate, taking your money sooner is good, but if you have discount rates that are consistent with today's interest rates, it wouldn't be so good. So if you look at the far right corner, you will see that the 66 leveling, the 66 present value of Social Security is greater than its 62, which I think, again, fits right in with John and Sita's numbers. So what it just shows is that now if the individual chooses the 2.9% discount rate for evaluating either option, of course those numbers are bigger, but we see that the Social Security leveling number would be lower than the present value of the maximum benefit. So this is all using, general assumptions for every man or woman in the two cases that we've got. So we do have some numbers in the paper, both some means and some regression analysis. This is a project that's still very much in production. We're using survey data that we've just completed over the last year or so and trying to get that data ready to go. But we see results that in some cases are what you might expect. Certainly men are more likely to choose leveling than women because presumably the shorter life expectancy comes into play there. And we've got a few other issues. The aging effect, again, as you saw in the table, clear is that the older the person is when they first start benefits, the less likely they are to choose leveling. So we look at this in a lot of different ways. We compare different kinds of workers because we know whether they're in the local government association. For those people that are in the state retirement plan and teachers, we know whether they're teachers, they're in some other government agency, or they're sort of what we might call general state employees. And the general state employees are more likely to choose leveling. So given the occupational issues that we heard discussed earlier, we can do some more of that. And there's been a general decline in choice of leveling since 2010. We started to call this a J&S effect. That would be for John and Sita, because we noticed people around the capital city, Raleigh, reading all of their papers about that time, saying people ought to delay Social Security. So what else do we know and what else do we need to consider? We want to know ultimately, since this is part of a working longer project, does it affect work after retirement decisions? And we have those data in our surveys, and we're now looking at those for some more result there. We would like to be able to say, what effect does it have on the age of Social Security claiming? And we have, again, survey questions on that we are in the process of analyzing as well. In terms of policy issues, one question would be, how would it affect individuals if the system sold or offered this issue using a 4% assumption on a discount rate or a 3%, and we already have some data on that, not in this particular paper. And then also, how would it affect if the state chose some other age for leveling? And the normal, what one might think about is, why not use the full age instead of the early age for Social Security? And would that affect all of these other things that we're talking about? So hopefully, if we go back to our questions that we started with, we've answered most of them in the paper. You're now experts on what Social Security leveling is, even though you never heard of it before. We know that a large number of public sector plans offer this, so it's not a mere curiosity or an anomaly to North Carolina. We know that at least in North Carolina, a substantial number of people choose this as an option. And we're still in the process of trying to look at issues that would affect, is this an option that improves people's welfare? One could imagine it could for some. Or does it have adverse effects along the lines of what we've talked about? Thank you very much.